Welcome, everyone. So, in our study of business administration, we're always looking at the big picture, right? Things like corporate strategy, marketing. But today, we're going to drill down into something that's really the bedrock of any healthy organization, and that's the power of internal controls. Now, I know when you hear a term like internal controls, your mind probably jumps straight to accounting or auditing. And you're not wrong, but that's only a small part of the story. The reality is, effective internal controls are the systems and processes that protect a company's assets, make sure the financial numbers are reliable, and just generally keep things running smoothly. For you, as future managers, as future leaders, getting a handle on this isn't just some technical skill you check off a list. It's a fundamental responsibility. It's all about building organizations that aren't just making money, but are also trustworthy, resilient, and built to last. So, let's get into it. Okay, to really get why this is so important, let's start with a scenario, something you'll definitely see out there. Imagine a tech startup. It's growing fast, the culture's exciting, everybody's doing a million things at once, and it's all about speed and innovation. One of their best software developers, we'll call her Sarah, realizes they need some new high-performance servers. It'll speed up their projects, make everything better, but it's a big purchase, maybe $50,000. On the surface, this looks totally fine, right? A smart investment to boost productivity. But let's really look at the process that happens next and ask ourselves, from a control perspective, what's wrong with this picture? So here's how the company handles buying things. Step 1. Sarah, our employee, puts in the request for the new servers. She does all the research, lays out the tech specs, explains why they need it. Step 2. Since she's the head of her team and has control over the budget, she just approves her own request. And then step 3, when the bill comes in from the server company, she's the one who gets it, gives it the final okay for payment, and sends it on to be paid. Notice a pattern here? We have one person, just one, controlling every critical stage of this transaction, asking for it, approving it, and paying for it. This kind of concentration is a huge, huge red flag from a control standpoint. And this slide really gets to the heart of the risk. When one person controls a transaction from start to finish, from the initial request all the way to the final payment, they're literally holding all the keys to that part of the business. Now, the critical issue here isn't that Sarah is a bad person. Let's assume she's fantastic, a total rock star employee. The problem is the system itself. You may have heard of the fraud triangle. It says that for fraud to happen, you need 3 things: pressure, opportunity, and rationalization. Well, this flawed process creates a massive, gaping opportunity. It opens the door not just for someone to intentionally steal money, say by working with a fake vendor, but also for simple mistakes, like paying an invoice twice or getting the price wrong, to go completely unnoticed. The system has 0 checks and balances built into it. So, what's the fix? How do we plug this hole? Well, the solution is one of the most fundamental principles in all of internal control. We call it segregation of duties. You'll sometimes hear it called segregation of functions. It's a simple concept, but it's incredibly powerful, and it directly solves the problem we just walked through. Let's get a formal definition down. Segregation of duties is a core idea that says no single person should be in a position where they can both commit and hide errors or fraud while just doing their normal job. To make that happen, you have to separate 3 key functions. First, there's custody of assets. That means having physical control over things like cash or equipment. Second, you've got authorization. That's the power to approve transactions. And third, there's record keeping, the job of actually recording everything in the accounting books. When you give these 3 jobs to different people, you create a system where one person's work is naturally double-checked by someone else. This quote just says it all, doesn't it? It's the principle in a nutshell. So let's apply it back to our startup. In the bad system, Sarah both authorizes the purchase and then handles the payment. There's no second opinion. In a good system, Sarah would still request the servers, but her boss, or maybe the head of the IT department, would have to authorize it. They check the business case and make sure it fits the budget. Then, a completely different person, someone in the finance department, would handle the payment, but only after matching the invoice to that approved purchase order. That second set of eyes is absolutely crucial. It ensures the company is only paying for things it actually needs and that were properly approved. This comparison makes it so clear. On the left, you've got the high-risk setup. That one person is a single point of failure. It's a straight line from beginning to end with no interruptions, which means it's an easy path for mistakes or fraud. But look at the right side, the low-risk model. Person A approves, person B pays. The absolute key is that break in the chain. Person B isn't just a robot pushing a button to pay. Their job is to verify that person A properly authorized it.
And person A knows they can't just approve some crazy purchase because they won't be able to process the payment themselves. See how that works? By just splitting the job between two people, you've fundamentally taken away the opportunity for things to go wrong. Now, here's a trap a lot of new managers and students fall into. They see a control like this and think, wow, the company doesn't trust its employees. But that's a complete misunderstanding of the goal. This is not about policing people. It's about designing a smart, resilient system. In fact, strong controls like this actually protect everyone. They protect the company's money and its reputation, of course, but they also protect the employee. They prevent a situation where an honest mistake could look like something shady, and they remove that temptation or pressure in the first place. A good control system just creates clarity and professionalism for everyone involved. So we've established that segregation of duties is a game changer. It's a super powerful rule. But here's the thing. A rule all by itself is never enough. You can have the most beautiful, perfectly designed process written down in a manual, but if the company's culture doesn't support it, it's basically useless. That rule has to live inside a bigger framework, and that framework is what we call the control environment. And that brings us to our next major concept. We're zooming out now, or moving beyond one specific rule to look at the whole ecosystem that all these controls live in, the control environment. So what is the control environment? Think of it as the foundation for everything else. It's the company's culture, its ethical values, the competence of its people. It's all about management's attitude and how they run the place. The phrase you'll hear over and over again is the tone at the top. Does leadership, through what they say and what they do, show that integrity matters? Or do they kind of signal that, cutting corners is okay if it gets results? That tone at the top trickles down and affects the entire organization. It determines whether people see controls as important or just as annoying rules to get around. This is the perfect way to think about it. If a specific rule, like segregation of duties, is a single brick in your wall of protection, the control environment is this solid, concrete foundation you build that wall on. If your tone at the top is weak, if the culture is bad, that foundation is cracked and unstable. And it doesn't matter how perfectly you lay your bricks, your individual rules, because if the foundation underneath them is rotten, the whole wall is eventually just going to crumble. So what does a strong foundation actually look like? Well, it's built on a few key pillars. First, clear leadership. That's the tone at the top we've been talking about. Leaders have to walk the talk. Second, well-defined roles. Everyone needs to know what their job is, what they're responsible for, and what they have the authority to do. Think clear job descriptions and org charts. Third, effective communication. The rules and policies have to be written down and shared with everyone over and over again. Fourth, an ethical work culture. This is about the unwritten rules. Is doing the right thing actually valued here? And finally, clear accountability. When someone breaks the rules, there have to be consequences, and they have to be fair and consistent for everyone, from the CEO down to an intern. When people see that, it reinforces the entire system. All right, let's put this all together. Let's talk about why this is so critical for you. As you leave this classroom and you move into your careers, you're going to become the people who design and maintain these control environments. This isn't just a theory from a textbook. This is a core skill for any effective leader. A lot of people have a really narrow view of internal controls. They see them as purely defensive, like building a fortress to keep bad things like fraud and errors out. And yeah, stopping bad things from happening is definitely part of the job. But if that's the only way you look at it, you're missing the true strategic value. The real, proactive, and positive goal of a great internal control system is to build and maintain trust. That's the whole point. You're building trust with your investors, who need to believe your financial numbers are real. You're building trust with your customers, who count on you to operate reliably and protect their information. And, so importantly, you're building trust with your own employees, who need a system that's fair, transparent, and designed to help them succeed. At the end of the day, trust is the most valuable currency in business, and a strong control system is what protects. So as you go out there, please keep these common mistakes in mind. First, don't ever think a rule book can fix a bad culture. Culture always wins. Second, don't ignore the small stuff. A bad control culture often starts in areas that seem unimportant. Third, remember, this is everyone's job, not just the accountants. And finally, always, always, always explain the why. When your team understands that controls aren't roadblocks, but are actually guardrails to help everyone win, they'll become your partners in keeping the system strong. So, I'll leave you with this final thought.
When you enter the business world, you're not just going to be another employee. You're going to be an active participant in building your company's culture and its control environment. With every decision you make, you'll have a choice. Are you going to see controls as just annoying red tape to get around? Or are you going to see them as essential tools for building a company that's based on integrity and trust? Ultimately, the question is, what kind of environment will you help build?